That's the closing bell on Wall Street, and now it's market domination overtime. We're giving you full team coverage of all the moves to get you up to speed on the action from today's trade. Yahoo Finance's Jared Blikre and Inez Ferre joining us here to break down the moves. Jared, we will start with you on that close.
Well, thank you, Josh. We have record closes for the Dow, the Nasdaq, and the S&P 500. Let's review the intraday price action. After the pop near the opening bell, really didn't do much except drift a slightly higher all day long. There's the Dow up 616 points to end the day. And here's the Nasdaq, a little bit less than that, 71 basis points or 0.7%. And the S&P 500, a little bit higher than that, but very similar charts among the three. And the S&P 600 up over 2%. So the small caps flying high today. And by the way, this was the best day for most of these indices going back to, I believe, August 12th. So don't quote me on that, but it's been a few weeks since we've seen moves like this. And let's just skip over to the heat maps that we have. We're going to check out the sector action. Energy kind of spoiled the party here, down a whopping 1 basis point. Everything else closed in the green. XLB is in the upper left. That's materials. That was up 2.06%. Followed by consumer discretionary, thanks to Tesla. Then you got healthcare, financials, real estate, communication services, all of those up more than 1.5%. And if we break down the Nasdaq 100, take a peek inside, you can see the mega caps actually split here. We got some weakness in Nvidia, Amazon, Meta, and Broadcom. Broadcom down 2.5%, but that didn't disrupt the party. We got big moves from Apple up almost 1.5%, and as I said, Tesla up 6%. Also notable is Micron up 7.5%. Taking a look at the Dow Industrials, Boeing is a standout. That was down 3% to the downside. But other than that, pretty nice day all around. 3M up almost 4%. Sherwin-Williams up over 3%. Home Depot up over 2%. And United Health nearly 2%. And I don't punch up the transports very often, but check this out. Only Delta Airlines in the red today. And aside from that, we got some standouts from CSX, that's up 2.5%, and JB Hunt up 3%. It was really kind of broad-based. I'm going to go for the meme stocks one more time because we really had some huge days for Open Door up 80%, Circle up 17%, BuzzFeed up 9%. So a lot of risk on today, not to mention I didn't even get to the IPO of the day figure, but that was up too.
All right, thank you, Jared. Inez, over to you. Taking a look at commodities, oil prices, feeling the pressure. Tell us more.
Yeah, and that's because of oversupply worries. You have the IEA, the International Energy Agency, which said that world oil supply hit a record in August. And the agency is saying that there will be supply going faster, growing faster this year, and also going into 2026. So what the IEA is now anticipating is a supply of 2.7 million barrels per day, a rise of 2.7 million barrels per day. That's up from 2.5 million that they had forecast previously. Also, the agency is expecting global supply to be at around roughly 4 million barrels per day in the first half of 2026. So that's some of the pressure that you are seeing with oil prices. Now, oil prices had started the morning lower anyways, and that is because of inventory numbers in the U.S. that came in higher than expected. But look, a lot of this oversupply worry is because OPEC Plus has been increasing production, and you also have non-OPEC members that have been also increasing production as well. So year to date, Brent is down about 10%. You've got WTI that's down about 12% year to date. That doesn't change the thesis from Wall Street. They're expecting oil prices to end the year a bit lower than what we're seeing right now, and for them to continue to go lower in 2026.
Thank you, Inez. Well, stocks closing the day in the green despite a hotter than expected inflation print. For more market reaction, we're bringing in Ross Mayfield now, investment strategist at Baird. Ross, great to see you. So listen, Ross, look at these markets. We got green everywhere. We got records everywhere. What do you make of these markets, Ross? Does the momentum continue, do you think?
It would seem so. I don't see much right now, at least in the near term, in terms of catalysts that could derail things. You have one day it's AI fueling big tech. The next day it's rate cuts fueling small caps, materials, some of the more cyclical names. So again, that backdrop of kind of a structural tailwind in terms of AI that's really permeating a lot of different sectors, and then a no recession plus rate cut backdrop, plus the optionality of you have the tax cuts, a lot of stimulus coming in the next couple of years. So there's a lot to like right now. And underneath it all is a fundamentally strong market with earnings quite strong. So could we consolidate here? Could we take a breather? Sure, you need to do that even in good bull markets, but pretty constructive on the next 12 months.
What about, Ross, negative seasonality? You know, I was talking to another strategist earlier in the show about that, but I mean, your opinion, is that a risk? Is that all in the rearview mirror? What do you think?
You know, seasonality to us is kind of like the thing on the margins that you can use to bolster or kind of tweak an investment case, but it's not a kind of a core tenet of a case, right? We entered this seasonally weak period with really strong momentum. We've seen plenty of August and Septembers that have been really strong in past bull markets. If you look at the late 90s, I think it was like 95 to 98. You had September was 4.5%, 5%, 5%, 6%. So this seasonality is something that you can use to kind of tweak a case. But if the rest of the case is bullish, I'm not going to use seasonality as a reason to turn bearish. And I think that's the message of what we've seen over the last couple of weeks as well.
What about sentiment, Ross? How do folks feel? I mean, is there any contrarian indicators there?
That to me is, I don't think we're there yet, but I think we're starting to be in a place where it's something to watch. The survey data is mixed. There's still some survey data out there that's fairly pessimistic, or at least not euphoric, but you see some of the meme stocks. You see, a risk on a day where, again, you had initial claims at almost a 4-year high. You had inflation, not necessarily cool. Obviously, we're going to get the rate cut next week that everybody wants, but the macro was mixed, and you still had this big rally today. So to me, there is a little bit of a sense of just real bullishness pervasive, and that makes sense now that we're 35, 40% off of the lows. But it starts to become a risk here. So that is something we're keeping an eye on.
Fed next week, Ross. If we get the cut the market expects, how do you think the market responds and reacts, Ross? Is that potentially a sell the news event?
Yeah, I think that's a great call. This rate cut is baked into the market. There's even like a 1 in 10 odds based on Fed fund futures of a 50 basis point cut. I don't think we're getting that. But there is a lot of rate cuts now priced into the market. And I think there's potential to get the rate cut we want, but for the SEP and Fed Chair Powell to be a little more hawkish than the market wants it to be. You know, at this point, Powell is not the dove on the committee anymore. We have, Waller and Bowman and several others making the case for more aggressive rate cut policy. And Chair Powell is going to be the one that gets in front of the cameras and has thrown cold water on some of the market anticipation at times in the past. So I think it could be a sell the news event, but you zoom out and directionally, we're still heading towards more rate cuts. And again, with the rest of the tailwinds behind the market. So even if it's a rocky afternoon, I don't think it's any reason to change the thesis altogether.
So bottom line, Ross, in the U.S. market, how do investors want to be positioned here, in your opinion?
Cyclical, risk on. I think to me, the one place that I kind of zag for the market activity today is you would get this, these rate cuts, this risk on environment should be good for small caps. I still want to favor large caps over small. I think the higher for longer rate environment, I think the way that the AI trade is playing out really favors the big names with a lot of cash, low debt, a lot of optionality to, whether it's to invest in infrastructure or do some M&A. So I still like leaning large cap, both in tech and AI, but also in the other cyclicals, whether it's discretionary, financials, industrials. But you do want to be risk on. You want to be leaning into a market at all-time highs with this kind of momentum. And I think we're setting up for a pretty solid 2026.
Ross, do I want to stay in the U.S. or should I also be looking overseas?
I think all investors should be looking overseas. I mean, the underrated story of the year is that international markets have continued to outpace the U.S. You've had this weaker dollar story that looks likely to continue. And just anecdotally, I think a lot of U.S. investors have thrown in the towel in international, and maybe they were right for doing so over the last decade. But I think in this world we're in now, the way that the trade is playing out, the way that we're kind of heading towards a more multipolar and deglobalized world, you want some international, some uncorrelated assets. I think there's a lot to like about what's going on in Japan, in Europe, in emerging markets even. I think the dollar story is big. So I want to have some international exposure. You don't need to fade the U.S. to get it because I think most people are probably overweight U.S. today. I would want to get to a more balanced positioning.
Final question, Ross. I do have, skeptics on the show, and they'll say, one variable they'll consider is valuation. They'll acknowledge it's not a market timing tool, but they just argue it's stretched, and that's leaving them cautious. Your response to that?
I hear the argument. Valuation is probably a little bit stretched here, but the one thing that I always push back on is the way that the market has changed over the years changes what your typical or average valuation or PE multiple I think should be. We right now have a market that is highly concentrated in asset-light big tech names that are high growth, high quality. And I do think that you should be paying a premium multiple for access to companies like that. And those are the companies that make up the stock market today. If you look at the S&P equal weight, valuation is at the top end of a range, but it's not stretched. And so I think, again, valuation maybe would argue for lower returns or more muted returns over the next 5 to 10 years. But as you mentioned, it's not a timing tool, and it's not something that factors into our investing case over the next couple of years, especially if we're in kind of this, innovation super cycle market that looks like the late 90s, where certainly valuation didn't matter then either. So it's a tough one. At some point, it probably will matter, but I'm not willing to get out of the market ahead of that run.
Ross, great to see you. Thanks for your time.
Thank you.
Taking a look at Adobe as its third quarter results just hitting the wire now. Q3, adjusted EPS, 531 versus an estimate of 518. Q3 revenue, 5.99 billion. The consensus was at 5.91 billion. So I have beats there on the bottom and the top. Turning ahead, Q4 digital media revenue, they are calling for between 4.53 and 4.56 billion. Estimates 4.51 billion. We also do have some comments here I want to bring you from the CEO, that would be Shantanu Narayan, saying Adobe is the leader in the AI creative applications category. He talks about AI-influenced ARR surpassing 5 billion, says AI first ARR already exceeding, he says, our $250 million year-end target. He talks about AI product innovation, the strong go-to-market execution, which is why he says we're pleased to once again raise our 2025 total revenue and EPS targets. And you can see, at least initially here, starts popping about 3% in the after hours. For a closer look at Adobe's latest quarterly results, we have Corey Johnson, Chief Market Strategist at Epistrophe Capital Research, host of the Drill Down podcast. Corey, so we should note, listen, sentiment around Adobe has not been great. That stock was down about 20% year to date heading into this print. It is popping here about 3% in the after hours. Give us the initial take, Corey. What do you make of this print?
Yeah, in context, down 40% over the last 12 months, right? So, I'm looking at my model right now as I'm punching the numbers in here. And what we see from this company is things are a little less, they're getting a little better. So RPOs that have been growing at 10 or 11% grow at 12%. That is the orders that they've taken in. Their digital media business up 11%. That's almost all the business here. And this last quarter was 75%. I'm pointing at my model over here, which you can't see, but I swear it's right here. And it's telling me that the digital experience business actually shrunk to 24% of the business. Now, that business had been struggling. The growth rates, it's growing to be sure, but the growth rates had fallen into single digits over the course of the last 18 months or so. It ticked up from about 6% growth to 7% growth. Okay, that's good. It's better. It's the direction you want, but it's not the double digits that we saw a few years ago. I mean, fundamentally, you've got to look at this company, who they're competing with, and you look at private companies like Canva that are sort of AI focused, easier to use for a broader base of users than the professionals who use Adobe products. I use Adobe products constantly because it's sort of a higher end of design, but it's not for everyone out there. And they're facing an interesting competition from Figma, which is of course public now, and they've tried to acquire, as well as from Canva here. And I think that those are the competitors out there in the marketplace that are hampering the ability of Adobe to grow.
You mentioned how that competitive landscape is shifting for Shantanu Narayan and the new AI-powered sort of creative tools, Corey, Chat GPT he's dealing with as well. I mean, as you think about that market, how it's evolving, what would you say Adobe's competitive advantages are there?
Look, it's the best design tools that have ever been invented, and the automation around those tools is the real opportunity and the challenge. They talked to the press releases that they just put out about how 99% of the Fortune 500 have used their AI tools with the software that they've got. And yeah, lots of us have tried to use AI tools on the different Adobe products. Some of them work more easily than others. The promise is there to do fantastic things with AI, to make the use of the products faster and easier, to make output faster and cheaper, so that in a rising economy, Adobe should do well. But can it really achieve that fantastic growth out there? There's a reason they went out to get Figma, because Figma had some things that they didn't. There's a reason that Canva is doing so well in the marketplace. And I think that those are the competition that Adobe's really concerned with. And that's why you've got a stock that's down 40% in 1 year, when they've spent so much on AI and introduced so many AI tools. And yet the growth here is in kind of low double digits on the top end, and in some important categories, even lower than that.
Let me ask you, we were talking earlier in the show about how, listen, you're a shareholder and a believer in Oracle. What would it take, do you think, to get excited about Adobe? Would it just be, would you have to see more meaningful acceleration in that AI business, in those AI metrics? Is that it?
I mean, I'm very picky, Josh. I don't just like kind of roll it. Oh, things are a little better, I'm going to buy this stock. I don't own a lot of stocks. I run a pretty concentrated portfolio. And so, Adobe, I think, look, Adobe's doing the right kinds of things. They're seeing the right kinds of results. But this is a company that's not growing in the fantastic leaps and bounds that we see in AI infrastructure right now, right? They sit at the top of AI use cases. They don't sit in the fundamental build out of AI and build out of AI data centers, where I think a lot of CapEx is going right now. Now, we don't see customers backing away from AI and backing away from Adobe's use of AI and moving to other prospects out there. But the competition is nipping at their heels and perhaps slowing their growth right here.
Final question, Corey, kind of bigger picture. How bullish are you on that mega AI trade and trend, the adoption curve for AI? I ask only because there have been some new questions raised about that. You saw the MIT survey. Everybody was talking about that. Yeah, I'm sure you saw Torsten Slok over at Apollo. He put out a note sort of talking about how, AI adoption kind of trending down, he said, for larger companies. Where are you on the theme?
Well, I think the argument changed this week. And it might have changed last week with Broadcom numbers, but it's certainly changed with that RPO number from Oracle. And again, I'll remind people I own the shares, so I'm biased on this thing. But we see the spending happening, and we see the promises of the spending happening. We see the funding of the venture capital community piling in to some of the bigger players in this with the crazy valuations for Anthropic and for OpenAI and for Perplexity. And I think we really see proof that this is where things are going right now. And while there's a lot of things that have to happen, I think you and I were talking on the phone this morning about the problems that Oracle's going to have finding the power to supply these the data centers that they're going to want to, that they promise to build. And they say they're going to, their RPO number that was so stunning depends on power to exist that does not exist out there, for power generation to exist, or importantly, for certain kinds of chips to do inference that will use so much less power than the cutting edge from NVIDIA and AMD right now. And I've got some private investments that are seeking to make chips that'll be a lot more power efficient, if not as powerful, to let for inference happen at a lower power scale, because that is one of the biggest challenges right now. There are big challenges out there, but this week we got news that AI build-out is going to be bigger than we ever imagined, and there are going to be certain beneficiaries of that will go far beyond Adobe, and certainly even far beyond Oracle. And those are the companies I'm writing about, the companies I'm researching, and the companies, some of which I will invest in.
Corey, always appreciate that instant analysis and a reaction. Thank you.
Got to go fast, man. World's not waiting.
All right, time now for What to Watch. Friday, September 12th. We're going to be getting a fresh read on the health of the consumer on Friday with the University of Michigan preliminary sentiment survey for September. Economists forecast that number to tick down slightly to 58, but barely change from August 58.2, signaling households remain cautious as they juggle sticky inflation and high borrowing costs. And digging into the details, current conditions are expected to edge up to 62, while expectations hold relatively steady at 56, showing consumers may feel a bit better about the economy now than about what lies ahead. Inflation expectations will also be in focus. Economists anticipate the one-year outlook to ease slightly to 4.7% from 4.8%, while the longer-term 5 to 10-year outlook is seen dipping to 3.4% from 3.5%. The new consumer data providing another piece of the economic puzzle as the Fed contemplates its next move, with interest rates ahead of its September FOMC meeting. With tariff uncertainty and a cooling labor market in the background, this report could set the tone for markets heading into the weekend.